If you've been watching the semiconductor space at all, our sources today are all pointing to one name that has, well, just defied financial gravity lately, Intel. I mean, this is one of the most classic names in computing, and they're in the middle of this monumental turnaround attempt. And the enthusiasm, the hype driving the stock, it suggests they might actually be pulling it off.
That's absolutely right. For anyone following the deep complexities of chip manufacturing, this is a crucial story because what the reports are showing isn't just some slow recovery. We are seeing genuine market-crushing momentum.
Right.
And it's all built on two massive technological bets: the future of AI chips and, the future of manufacturing independence.
So our mission today is really to cut through that noise, to get past the hype around this stock surge. We need to understand the exact mix of new tech and hard financial data that's fueling this rally.
And we also have to ask that critical question.
Is the price justified? Or are we just in pure speculation territory here?
Well, we have to start with the headline numbers. They're pretty staggering, and they're really what's generating all the attention.
They are jaw-dropping. The reports say the stock is already, and I'm quoting here, crushing the market in just the first few days of 2026.
And the year-to-date gain is already clocking in at 15.5%.
15.5% already.
And you can't look at that number in a vacuum. You have to remember the context. That gain is stacked right on top of a monumental performance from last year.
The stock surged by over 80%.
Over 80%. When a legacy tech giant, a company like Intel, generates that kind of run, it forces everyone from hedge funds to individual investors to stop and really pay attention.
80%. That's the kind of return that makes you rethink your entire portfolio.
Sure.
So, okay, let's unpack this. Because those kinds of returns, they aren't built on just slightly better desktop processors.
Right.
What is the technological engine driving this?
It is entirely built on forward-looking tech, which is why the sources are treating this moment as a real inflection point, not just another upgrade cycle. The excitement is fueled by two huge concepts: the new chip architecture itself, and then the underlying manufacturing process.
Let's start with the architecture then. The new Core Ultra Series 3. They're calling it their first AI personal computing platform. What does that actually mean for people using the hardware?
It's a foundational shift. For years, performance was all about the CPU, the central processing unit. Now, performance is defined by how well a system handles AI tasks, and that needs a whole new kind of engine.
A new engine.
The Core Ultra Series 3 has what's called a neural processing unit, or NPU, built right in.
An NPU.
Right. And it's designed specifically for those AI tasks, like running a large language model locally, generative AI, or even complex stuff in the background, like advanced noise cancellation, all without constantly hitting the main CPU or needing the cloud.
So instead of your computer having to send data out to some massive server farm, the chip can run powerful AI stuff right there on your desk, what we call edge AI.
Exactly. And that shift is why they can make such bold claims. They state the Core Ultra Series 3 has a distinct competitive advantage in critical edge AI workloads.
And there's that one specific number that everyone is quoting.
The big one.
Yeah.
The chip offers, and this is their number, up to 1.9x higher large language model performance, plus it's more power efficient.
That 1.9x multiplier, that's the bullet point that sells the story. But can we translate that? What does nearly double the LLM performance actually look like in the real world?
Well, think about speed and privacy. If you're running a local AI tool, say, summarizing a long document or drafting some code, you're doing it almost twice as fast as you could with their last generation of chips.
And the privacy part.
More importantly, because all that processing is happening locally, your data stays on your machine. And that's a huge draw for enterprise customers, for professionals who are worried about security. This is basically Intel saying, we are making the AI PC a real thing right now.
Okay, so that's the chip. But the other half of the story, and maybe the bigger piece for their long-term value, is where these chips are being made.
Yes. The new US-based 18A semiconductor foundry.
This feels like a huge strategic play.
It's a critical investment. The 18A foundry is built on a monumental leap in manufacturing tech. The A stands for angstrom, which is 10 times smaller than a nanometer. By pushing into the angstrom scale, Intel is signaling they're back at the cutting edge, maybe even ahead of it.
I remember the press release being exceptionally bold about this. What was the exact claim?
They asserted that the 18A process is the most advanced semiconductor process ever developed and manufactured in the United States. That's not just marketing talk. That is a direct challenge to the global foundry leaders.
And it speaks directly to the whole geopolitical situation, right?
Yeah.
So what's the dual benefit they're selling here? by focusing so much on the U.S.-based manufacturing.
And that's where the massive long-term opportunity really is. The market isn't just excited about Intel selling its own chips. The sources suggest the real prize is attracting other customers.
So becoming a service provider.
Exactly. In a world focused on supply chain security, having a US-based 18A foundry could attract other big chip designers who currently rely on overseas production. What's fascinating here is that the Core Ultra Series 3 chip proves the tech works. It makes Intel both a competitor and a supplier.
That would accelerate their turnaround exponentially.
It's a potential game changer.
Okay, so that's the tech fuel. The market is clearly betting on that dual strategy. But specs, they're still abstract for most investors. The financial trajectory is the real acid test. We have to move from potential to actual performance.
Absolutely. The hype is meaningless without financial improvement, and this is where the sources show some really compelling evidence. You have to look at their recent revenue track because it shows them climbing out of a very deep hole.
So lay out that trajectory for us.
Okay, so let's start where the turnaround really began to pick up steam. Fiscal Q4 of 2024 was rough. Revenue was down 7% year over year, but then things stabilized. Fiscal Q1 and Q2 of 2025, revenue came in flat year over year, which, in the cyclical semiconductor market, flat is way better than declining.
Flat means the bleeding stopped. But the real breakthrough, the thing that lit a fire under the stock, must have been the most recent quarter.
Precisely. Fiscal Q3 2025 revenue finally tipped into positive territory. It rose 3% to $13.7 billion. So if you just chart that out, down 7% to flat to up 3%, it's concrete evidence that their strategy is finally starting to work.
And that revenue gain came with the all-important pivot to profitability. That has to be the most convincing data point for the doubters.
This is critical. In Q3, they swung to a substantial profit. They reported earnings per share, EPS, of 90 cents.
A 90-cent profit.
Right, and that number only tells part of the story until you contrast it with the past. They reported a brutal loss of $3.88 in the year-ago quarter. Even in the prior quarter, Q2, they lost 67 cents.
Wow.
So going from that kind of loss to a 90-cent profit in such a short time, that's the kind of clean signal that can sustain a massive stock rally.
And management is pointing to some big industry tailwinds for this reversal.
Yes, the CEO, Lip-Bu Tan, he noted that AI is accelerating demand for compute and creating attractive opportunities across our portfolio. So they see AI boosting everything: PC sales, their legacy chips, their new specialized chips, and the foundry services side.
A comprehensive boost.
It's lifting all their boats.
And there was one last crucial detail from that Q3 report, something about supply and demand that sets a very optimistic stage for 2026.
This is key, because it speaks directly to future pricing power. Management observed that demand for their products was actually outpacing supply in Q3.
So they can't make them fast enough.
And they were confident enough to say they expect this trend to persist well into 2026. If demand is higher than what you can produce, that gives you leverage to command better prices and maintain high margins.
Okay, here's where it gets really interesting and where we have to pump the brakes a little bit. Are investors getting ahead of themselves? The financials look solid, the tech is compelling, but the stock has already run up over 80% last year and another 15% this year. That valuation is just enormous.
And that is the central valuation dilemma. Despite the recent positive momentum, the company now has a market cap of over $200 billion. And you mentioned those staggering losses from last year, a $3.88 per share loss.
It's hard to square those two things.
The critical view is that this $200 billion valuation reflects almost pure, perfect optimism about the future. A future where they achieve massive, sustained profitability, not the confirmed, consistent profitability of today.
Wait, so $200 billion for a company that was posting a nearly $4 a share loss just a year ago? Isn't that just speculative madness?
Yeah.
What concrete evidence justifies that level of confidence right now?
That's the tension the market is dealing with. The confidence is based on the idea that, one, they've navigated the cyclical downturn, two, they have a technologically superior product in the pipeline with the AI PC.
And three, they're addressing the huge geopolitical demand for U.S.-based manufacturing. So investors are essentially saying that even if profitability is a bit choppy for another quarter or two, the inevitable growth from AI and the foundry business is worth $200 billion today.
So the prices run up on these claims, but when do we get the actual hard data to prove that the mass market adoption is really happening?
That is the key unknown, and it creates a really tense short-term window. Pre-orders for the new chips started January 6th. Global availability is January 27th.
Okay.
But the crucial insight, the actual customer demand, the order volume, that's not likely to be public until Intel reports its Q4 earnings on Thursday, January 22nd.
So for the next couple of weeks, the price is just flying on theory and momentum, but the real test, did people actually buy enough of these chips, is still winks away. That feels like a huge risk. It is, and that's the core risk factor the skeptics are pointing to. The view is that the risk of disruption, maybe a competitor releases something even faster, or maybe corporate demand for edge AI is just weaker than expected. Those risks are just too high right now.
Right. So if that Q4 earnings report on January 22nd disappoints in any way,
The stock could see a very swift correction, especially given how far it's run up from a year ago.
which brings us back to what some of the source authors concluded, their decision to just stay on the sidelines.
It's a very rational, risk-averse position to take. The pace of change in the chip industry is just accelerating. They acknowledge Intel is moving in the right direction, but the current valuation has priced in so much perfection that any stumble, a delay, a big order cancellation could lead to rapid value destruction. They'd rather wait for confirmed execution.
So if we synthesize all of this for the listener, where does this leave you? You've got all the essential pieces now to understand this very complicated turnaround story.
It leaves you with a really clear balance sheet of facts. On one side, you have powerful tech innovation, that 1.9x performance claim, the strategic advantage of the U.S. foundry, and it's all backed by clear evidence of a financial trajectory that is improving.
Moving from deep losses to a strong profit.
A huge swing.
But on the other side, the stock's current price reflects an optimism that hasn't been fully validated by customer data yet. And it demands sustained, strong, consistent profitability just to rationalize that massive $200 billion plus market cap.
The sources seem to suggest that an eventual return to strong growth seems inevitable, given the tailwinds from AI and their dual strategy. But the critical issue you have to consider is this. Intel is expecting demand to outpace supply into 2026. So the question isn't if they can grow, but can they grow $200 billion worth of fast?
Right.
What is that tipping point where the perceived risk becomes justified by confirmed, verifiable customer adoption? Growth that actually meets the sky-high expectations already built into that share price. That's the tightrope the company is walking right now.